This is 20 lakh in 10% debt, another 10 lakh, 10% preference share, another 10 lakh in equity. How the 40 lakh have been made? 50% in 10% division, 20 lakh in 10% preference share, another 20 lakh in 8% debenture. 3 lakh 8,000 minus 2 lakh, 1 lakh 8,000. Profit available to equity shareholder. Hello my dear students, I am Dr. B.S. Subramaniam, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Year College, a Temple of Excellence, MYSURU. In this session, I am going to have Financial Management 4th semester, Unit 3, Session 2 of BBA in favor of cost of capital. In the last session, I already explained that in the cost of capital, we are dealing with capital structure now. This is the third problem we are going to face. The capital structure of a company is rupees 45 lakh. This is rupees 45 lakh with only equity share, entirely equity shares. The company wishes to raise an additional capital of rupees 40 lakh. This is important. This is additional. For its expansion, it has 3 financial plans to raise 50% in 10% preference share capital and 50% in 8% debenture. How the 40 lakh have been made? 50% in 10% division, 20 lakh in 10% preference share, another 20 lakh in 8% debenture. Second one, to raise 25% in equity capital. So 10 lakh in equity capital and 75% of 40 lakh is nothing but 30 lakh. This is 10 lakh in equity, 30 lakh in 9% debenture. To raise 50% in 10% debenture, 20 lakh in 10% debenture, 25%, 1/4, 10 lakh in 10% preference share capital and 25% in equity share capital. So, we'll go slowly. What is your existing capital? 45 lakh. Existing shares. Is equal to 45 lakh divided by 100. Number. This is 45 followed by 50 divided by 100, 45,000. This is existing share. Expansion amount required rupees 40 lakh. Amount required is how much? 40 lakh. Now, first plan. What does the first plan says? To raise 50% in 10% preference share capital. Only 2 items. %50 in 10% preference share. 50% means 20 lakh in 10% preference share capital. Preference share. Another 50%. 8% debenture. Rupees 20 lakh. 8% debt. Debenture. Totally 40 lakh. How it will happen? 20 lakh in 10% preference. Here preference dividend will come. Another 20 lakh. 8% debenture. Interest on debenture will come here. Now, second plan. How many divisions are there? Second plan. To raise 25% in equity capital. 25% in equity capital, 75% in 9% debt. So 25%, this is 25%, 1/4, 10 lakh in equity. 30 lakh in 9% debt. So now, third plan. Third plan, come back to raise 50% in 10% debenture, 25% in preference share capital, 25% equity. 53 items. First one, 50% in 10% debenture. 50% in 10% debt. That is 20 lakh. First case is this is A. B. 50% in 10%, 20 lakh in 10% debenture. Raise. 25% in 10% preference share cap. 25% means 1/4, 10 lakh in 10% preference share capital. Preference dividend. Third case. This one. Then 25% in equity capital. Another 10 lakh in equity. These are all the three cases. First case, 20 lakh in 10% preference share, 20 lakh another 8% debenture. Second plan, 10 lakh in equity, 3 lakh in 9% debenture. Third plan, this is 20 lakh in 10% debt, another 10 lakh, 10% preference share, another 10 lakh in equity. So this is how to make this working note. This is a working note. Hope you understand this working note. Beautifully it has been drawn here. Slowly I have drawn and explain this according to whatever they gave. Calculation of earning per share. Calculation of earning per share. Particulars. First plan. Second plan. Third plan. Who draw this? It'll go. What's your EBIT? 6 lakh. Earning before interest and taxation, 6 lakh. Minus interest on debt. Now, come back. First case, 20%, 8% debt. 20 lakh, 8% debt. First plan. 20 lakh at 8%. B. Second plan. This over. Second plan. 30 lakh, 9% debt. 30 lakh at 9%. C. Third plan here. So 20 lakh in 10% debt. 20 lakh at 10% debt. Procedure here as per the working note. We'll start. 20 followed by 50 into 8 divided by 100. 1,60,000. This comes here. 1,60,000. Then 30 lakh into 9 divided by 100. 2,70,000. Then this is 20 lakh, 10% means 2 lakh. Deduct. If we deduct this now, 4,40,000. Deduct 3,30,000. Deduct 4 lakh. What is this? Earning before taxation. Earning before taxation minus tax at, what's the rate of tax? At 30%. So 4,40,000 into 30 divided by 100. 1,32,000. 330 into 30 divided by 100. 99,000. Then 4 lakh into 30 divided by 100. 1,20,000. Deduct 4,40,000 minus 1,32,000. 3,08,000. 3,08,000. 330 minus 9930, 2,31,000. This is 0, 0, 2,80,000. Earning after taxation minus preference dividend on preference share capital. Come back here. First plan 20 lakh 10% preference share capital. First plan 20 lakh 10% preference share capital. Second plan equity 75. No, nothing is there. Second plan nil. Third plan come back. Third plan here 25% means 10 lakh in 10%. 10 lakh in 10% preference shares. Here, first one 20 lakh, 10% means 2 lakh. Second plan nil. Third plan 10 lakh, 10% means 1 lakh. So this is the way. Particulars. First plan, second plan, third plan. Particular, first plan, second plan, third plan. This is earning after taxation. If we deduct this, no? 3,08,000 minus 2 lakh. Profit to equity. Profit to equity. If we deduct 3,08,000 minus 2 lakh, 1,08,000. Profit available to equity shareholder. Second one, this is 1,08,000. Now, 2,31,000. 2,31,000. Regarding the C, 1 lakh gone means 1,80,000. This is profit to equity. It is profit to equity divided by number of equity shares. Existing plus new. How much existing you got? 45 lakh. Existing plus new. Plan, first plan. 45,000 plus. First plan how much? No equity is there. Exist only come nil. Second plan 45,000 plus how much new? Here 25. 10 lakh divided by 100. 10 lakh 10 20 30 divided by 100. 10,000. 10,000. Third plan 45,000 plus here 10 lakh means 10,000 shares. First one 45 lakh 45 2030 divided by 100 45,000 shares. Now come back here. So 45,000 divided by number of shares 45,000. Second one 55,000. Third one 55,000. Earning per shares. Earnings per share. So 1,08,108 divided by 45,000 2.4. Then 2,31,000 divided by 55,000 share 4.2. Then 180 divided by 55,000 3.27. Repeat. 2,31,000 divided by 55,000 shares. So since EPS is more in second plan when compared to first plan and third plan, plan 2 is selected. So plan 2 is selected because highest EPS is there. We have done, and all working note is most important here. We have done everything here. Hope you understand how to bifurcate. First, slowly you calculate the working note, equity how much, or when you are dividing, what is the format? EBIT, earning before interest and taxation, minus interest on debt, minus tax, minus preference share dividend, divided by number of equity share. Existing plus new. Existing plus new, you have to do it. Then, whichever highest earning per share will come, that should be selected. Hope you understand. We'll go with next session, weighted average cost of capital. Hope you understand this capital structure. We'll move on to weighted average cost of capital.